Welcome to another exciting edition of the Trading Bell. Today we are coming to you from the Nairobi Central Business District, the headquarters of Family Bank, one of the major banks in the country. And we'll be speaking to Rebecca Mbithi, who is the Managing Director as well as the Chief Executive Officer of the bank. She'll be giving us a sense of where the bank is headed in regards to growth, as well as what has been the scenario like when it comes to coping during a pandemic year. Before we get into that discussion, let's take a look at her profile.
Rebecca holds an MBA with a concentration in strategic management from USIU and an LLB degree from the University of Nairobi. She is a CPA and a member of the Institute of Certified Public Accountants of Kenya, a certified secretary, and a member of the Institute of Certified Secretaries, an advocate of the High Court of Kenya, and a member of the Law Society of Kenya. In addition, she is a certified executive coach. She joined Family Bank in January 2015, taking on the role of Company Secretary and Director, Legal Affairs. Rebecca was appointed CEO of Family Bank in February 2019. She is a seasoned professional and a respected lawyer with an extensive leadership background in various organizations, having previously worked at Kenya Tea Development Agencies, where she served as Head of Legal and Regulatory Affairs, and Rift Valley Railways, where she served as Company Secretary and Legal Counsel. She has vast domain expertise and knowledge in law, project finance, corporate restructuring, equity debt raising and governance, and has served in the Corporate Governance and Standards Committee in the Institute of Certified Public Secretaries, Kenya.
Thank you so much, Madam Rebecca Mbithi, for hosting us, and such a pleasure to have you on the show.
You're welcome. Welcome, Abby.
All right.
Yes.
First time to have you on the program, of course. I know you're a very athletic person. Over and above that, you are one of the few women that is charting and charted paths in the financial sector in Kenya. I'd like just to begin by getting a sense of where we are as a country when you look at the financial sector, and of course, as a bank. Is banking still profitable?
Well, a good question as to where we are as an industry. I think banking over the years has seemed to be one, and has actually been one of the profitable enterprises we've had, contributing significantly even in our Nairobi Stock Exchange in terms of market capitalization. So it has been a good run for the banks with a few challenges here and there. However, of course, like every business, the banking sector has hit a few headwinds, and significant headwinds I would think about are currently the pandemic that we are going through, which came to be last year around March, with the first case being announced in Kenya. So that's been a major headwind for the banking sector.
All right.
And obviously with it, because we are in an economy, we serve customers who are affected by whatever is in the macro environment, the pandemic. As a banking sector, definitely we have had to go back to the drawing board as businesses and see how we emerge from this particular challenge. We took an industry position as a bank, as the Kenya Bankers Association, supported by our governor, on the various areas we would need to do just to come into play as a sector, just to support Kenyans. The three that come to mind is, first and foremost, we realized that a lot of the businesses, a lot of the small, big businesses would be affected by the pandemic. And as the lender of a lot of these institutions, then the question of their ability to repay their facilities based on the reduced business activities, the lockdowns that we witnessed, was something we had to really look at the solution for it. Obviously, being players in society, we had to be understanding. So we had to create a mechanism of supporting businesses, and this was through the industry position where we agreed we would be restructuring facilities for businesses that were hard hit by COVID, and that we did pretty well. Family Bank also was not left behind. We're looking at approximately 25% of the loan book we held at that particular time, a largely predominant SME loan book being affected. And we also stepped in, restructured facilities to the tune of around 16 billion. The other thing we realized with the pandemic, we would need to change the way then we, as a public, we handle payments. So with lockdowns, with a potential warning that cash handling was one of the major gray areas in transmission of COVID. So we all came as an industry, agreed then to perhaps move a lot of the transactions to digital. You recall that we did zero rate a lot of the transactions just to make sure that the public handling of cash was limited. So that those are in summary some of the challenges, some of the initiatives we had. Some of them are still continuing up to date, despite the situation easing. All of us getting a better understanding. Businesses now fully back, some sectors fully recovered, others still struggling. But I think all in all, the banking sector at least now has a good understanding of the pandemic. We've been able to know how to support the public, the businesses, and I feel we are coping better than we did at the start. And we've also seen new ways emerging of doing business. We've not been left behind, so everybody moving digitally. Family Bank being one of those that have really invested in the digital era. Actually, recently, our customers voting us pretty well in the market on digital and customer responsiveness. So I would say that those are some of the things then as an industry and the challenge and how we've been able to overcome the challenges that have been presented by COVID.
Quite extensive opening remarks there, Madam Mbithi. And I'm curious to find out, of course, banks were able to readjust the loans for customers. At the same time, how significant did the pandemic impact on your books? When you look at majority of the banks that are listed, if not close to 10% of institutions in Kenya reported profit warnings, signaling a turbulent year for not only the banks, but generally the economy at large. As a bank, how significant were you dented by the pandemic?
We were dented, we were not left out in terms of the impact of the pandemic. I did allude to almost restructuring 25% of our book. Family Bank predominantly does finance the SME market. 60% of our loan book is to the SMEs. So this was a sector that was hard hit. Predominantly because COVID did come in and cut a bit of the supply chain that we were looking at. A majority of our customers do tend to import some of their machinery, raw materials from some of the countries such as China, India. So with that supply being cut, government, of course, stopping some imports in key areas, especially for the micro space. The traders in some markets like Gikomba, where we have 2-3 branches, would see that them being impacted. But the good story around Family Bank, and perhaps why we did not see a huge impact despite the restructures, is that we quickly, as a team, as a board and management, went back to the drawing board. Because in the midst of challenges, you really do have to reevaluate your strategy. What is it? The opportunities still, despite a very hard period, you can see in the midst of the challenge. So we saw the opportunity. Our customers, as I alluded, the SMEs, the corporates, came to us and said, you know what, times are tough, but we've seen opportunities. We are in thriving sectors. Are you able to support us? So amidst the pandemic, Family Bank continued to lend to its customers. In fact, we witnessed a growth of almost 11% in our loan book to sectors that were thriving. And when I talk about this, I think there was quite a bit of opportunity in the market. We saw agribusiness space thrive. we saw some components of logistics, manufacturing thrive, and actually even the medical practice, we saw quite a lot of appetite, and we were able to support those sectors. So this shielded the adverse effect we would have otherwise experienced.
Sure.
So we managed to cushion ourselves against that, despite the sharp increases in the level of provisions for bad debts.
I was actually coming to that.
Exactly. So you've seen the industry actually witnessing a spike in the provisions for bad debts. Family Bank also witnessed our bad debts year on year, comparing 2019 to 2020, grow by 2.5 times, which is pretty significant.
Sure.
So this did dent, obviously, our position, our profit position, but then nevertheless, because of the growth that we witnessed in the loan book, in the loan fee income, we were able to still record at least just a 2% decline in profitability from our 2019 position.
Right.
Yeah.
And very moving sentiments there. Of course, the road to recovery is still bumpy, but resilience will help the financial services sector to overcome this. I'd like to hear your thoughts around where does the future lie in banking, especially now that many of the institutions had to reevaluate their strategies, and we're moving away from the brick and mortar. The new space for consumers is the mobile phone.
Yeah, you're absolutely right. And as I said, these are some of the opportunities that came and some of the realizations and lessons around the new way of doing business, and that was digital. So I think every bank in Kenya, also Family Bank, we've really had to invest heavily on digital. But why that was also a blessing is because it also helped us create efficiencies within our operating models. So perhaps the cost of service on a digital platform is less than that on a brick and mortar. So what it does, as we've all invested in the digital platforms, it's freed up a lot of our capacity. So what does that capacity mean for us? It also is good news to the customer, because then it allows us to be more customer-centric.
Sure.
So what I will note is that during this difficult time, you actually need customer responsiveness. What has also helped Family Bank in getting a lot of its customers back on track despite the pandemic is the relationship management model. So we've been able to walk through our customers just to understand what is happening in their business, their turnaround program, and a lot of them with our support, some technical support advice, some access to credit, we've been able to see them recover. But what does that mean? That means you've got to apply resources to manage that relationship, and also make sure you're more responsive to your needs, because the needs are not going to be the needs of yesterday. The needs are also evolving in the midst of all that we're going through. Maybe trade finance is the way to go instead of then most of what we used to see previously, which is perhaps real investment infrastructure and all that. So there are, as I said, there is definitely a change in all our operating models as banks, and we will all continue to then invest then in the digital space because of all the opportunities, and also the customer has seen the benefits of convenience that comes from the digital space. So I hardly believe that there's any customer who will be going backwards, because today convenience, as you've said, is on your phone.
Sure.
Saves you time, money, and also makes it easier for you to be able to transact and improves your overall customer experience.